All right. Looks like we're live. Welcome to the Standout Business Show, the show dedicated to helping you make a bigger difference by doing business differently. I'm Brad Powell, your Standout Business Coach, and today we are talking about creating income independence. Now, there's probably not a single person on the whole planet who wouldn't like to achieve some form of financial independence. And yet, the surest path to get there remains a mystery to most of us. But what if you could create a growing stream of reliable spending money? And you could stop obsessively scrolling through your phone, looking about the news about inflation and how sort of the financial world is going to hell in a handbasket. And you can stop worrying about having enough money to retire. Well, today's guest, his name is Steve Selengut, and he's a 44-year investment professional. And he's coming on to teach us his simple yet little-known system for investing in the stock market that shouldn't be a secret, but it is. So if you're looking for a way to achieve financial freedom that delivers reliable income and works whether the stock market is going up or going down, then stay tuned. And with that, let's start the show. All right, Steve, welcome to the show.
It's so good to be here. It's, I know from our previous conversation that we'll be having a good discussion here today.
Right. All right. Well, to get us started, everyone has some idea of the stock market. And so people have their retirement accounts, usually through their employer, or they've been dabbling with some kind of investment or another. And I think most people see it as possibly a good thing, but they also see it as kind of a risky thing because if you're our age, you've definitely lived through some ups and downs in the market, especially the recession of 2008, 2010 period, and people are going, oh no, I know people have lost a bunch of money, and yet you are coming on the scene and going, well, actually, there's this way to do this that is safer and not just more reliable, but actually will provide an income for you that's greater than most people's portfolios is providing for them. And this is the thing that I find most intriguing. So what are most people missing when they think about the stock market?
Well, they're thinking that they're looking at the stock market as something of a gambling device, of a tool, and the terminology that is associated with it in the press and the media makes it seem like you're betting, like you're possibly a Las Vegas type terminology associated with investing in the stock market, which for a lot of people is pretty true. And for some of the approaches you can take to investing, if you are very speculative, can also be things like puts and calls, or are kind of betting on which way the price of a security is going to go. All of those types of guesswork and looking for the magic symbol of the next Microsoft or Google or Amazon generally doesn't work, because if you looked back at the statistics about new companies coming to market, you would see that very few of them actually get into that hero status. The numbers are probably like more than 90% don't become those heroes, those stars that everybody who invests in them becomes a millionaire. And unfortunately, many of these things do go up for a while, and people get complacent with their ownership, and all of a sudden, a few quarters of less than spectacular growth in income, and the stock price plummets because typically they haven't started making profits yet and they aren't paying dividends. So they become less of a good horse for the race to become successful. Most people go into investing with that type of a gambling outlook instead of looking for quality, diversifying properly, and most of all, generating income from the securities they invest in. There are at least three different types of fund vehicles that people can use to diversify immediately, own a whole bunch of stocks or own a whole bunch of bonds and mortgages and real estate and stuff like that, instead of placing uh, all their money on one horse or three horses in in a market that contains literally thousands of different companies that you can invest in. So that's the key issue. Do I want to place all my money in a gambling type environment, hoping that I'll be successful, or hoping that an advisor will pick a portfolio that'll work for me and it'll go up more often than it goes down, and at some point in time I'll be able to convert it into a stream of income? Or do I go right for that quality immediately, start generating that stream of income while I'm still young, so that by the time I get near retirement age or into my current business or profession 20 years on, I'll have as much money coming from this investment portfolio as I do from my business earnings or my salary. Um, that seems to be a much easier way to get to those final years of life, with the income already in place. And the longer you do it, the more you'll be able to grow it. And the more you'll be able to not only pay less attention to these gyrations of the market and the predictions of market corrections and so on, you'll actually be able to take advantage of them when they occur. You'll be able to create a faster growing stream of income, and also uh, a better potential for future profits, um, by using these market corrections to your advantage. And that's the type of approach to investing that I've been taking, that I had taken for my clients for 40 plus years, and that I'm now teaching to new people that come to me for advice on how to get to what I call income independence. And I define that. Define that very clearly. It's the ability to say that neither a market correction or higher interest rates are going to have any negative impact on my income, my cash flow. And in fact, either of those two events, which may take prices down, will help me grow my income even faster.
All right. So I want to uncover some of this mystery. So we're talking about a very specific type of fund that you prefer, which has got the acronym, the CEF. And so, and this is different than what people are mostly familiar with, like a broad mutual fund with Fidelity or something like that, that they have in their IRA or 501k kind of fund.
Mm-hmm.
And where in my understanding, which is kind of minimal, is that you own this collection of stocks and they're sitting there at a certain value, and if the market is going up, then your wealth increases, and if the market goes down, your wealth decreases, and you don't see any of that money until at some point later you decide to sell the stock, and hopefully it's at a larger amount than when you bought it, and that's where you make the money. And most people, when they're thinking about the stock market, they're playing that kind of game, prediction game of like, well, I'm going to predict that this group of investments is going to increase in value over a period of time, and that is how I will earn my income in the future. And you're talking about something very different, which is that the kind of investment that you make is providing income that's coming in on a regular basis, year after year, and you're not just waiting for some future event. So anyway, describe that whole approach.
Okay.
And you don't have to go like the whole thing. Just say, okay, well, what we're talking about is this kind of
Yeah, what
fund.
what we're talking about is you're you're taking an approach that focuses more on the income production of these types of securities you're talking about, be they stock market, which stock market investing is ownership of the different companies. You own shares of stock. Um, a safer form of investing in the very same companies and governments and things like that is bonds, preferred shares. Real estate is considered safer, mortgage investing as well, um, because they're debt securities, and in all environments, the debt securities have to be paid before shareholders are paid in the corporate realm. So they're in that sense they're financially safer. But you want to own both types of securities, and funds of all three kinds give you that ability. You can own a mutual fund, an ETF, or a closed-end fund that contains pretty much any stock you could possibly buy on the exchanges. You can buy funds that specialize in particular sectors like AI or healthcare or energy. Um, you can buy funds that have a global a global focus, or a mixed focus of all the all the world and so on, without placing a whole lot of money in any one share. Um, Three types of funds allow you to do that. Um, they're they're each a little bit different. Closed-end funds are the oldest of the three. Um, they are the only ones that operate like a trust, a pass-through trust. So the any income, the net income that they make throughout the year, 95% of it has to be passed through to their shareholders. So they're that's the good news. The bad news is, if it's considered bad news, they're not going to blow up in price just because the market goes up, because their intention is to take profits and provide income to their shareholders. They're not there to grow huge market prices. I own, say, 260 of these things, and the highest price of any of them is in the low $40 range. The average price of these 260 different funds containing literally thousands of different securities of all kinds is right in the 10 to $12 a share range. And I've owned these things more than 20 years, and I've never seen one go up in price above that level that they are right now. And
Right.
that's because that's not their intent. At the same
Right. So
time,
these closed-end funds are really the type of investment that you highly recommend because they provide income in terms of dividend payments and this whole thing, the 95% pass through that they're
right,
required to do
mhm,
is really different structure than a regular mutual fund investment in
right,
that. And yes, they don't necessarily increase wildly in value over time, but because of the fact that they're providing this income, it's that's a that's a game changer in terms of, well, what's your return year after year?
yeah. Your return is a word that's used on Wall Street to describe the net change year over year in the market value of what you own. If the market goes up 15%, and you're making as much as maybe 1 or 2% in income, so your total return will include that income plus the increase in market value. In a down year, or in years like the past three, where the market has gone up at best 7% a year, and most of that's been in the last 13 months. Um, that's what you got. You've got a 7% growth. Your income hasn't changed. In fact, it's probably gone down. in percentage terms because your value has gone up and nobody's changed their income production. Whereas if all of your if even if you had zero growth, if you were making 9 or 10% a year in income, you're you're you would have a higher total return as well as income production that has grown because you've been reinvesting that 9% over those past 3 years. So it's and even though your market value hasn't changed, uh, other than because of the production of income. So it's what's gone into that total return that's different. Okay. I don't even look at total return. I never even mention the words. I look at growth in income and growth in the capital that's invested to produce that income. So that gives you another aspect. There's really two income streams with this fund type of investment, with closed end funds anyway. Um, the object of the exercise is to have a broad variety of these things. And when they go up in price, I take profits and I reinvest in either some similar type fund or a different fund. It doesn't matter. Or I even add to funds if they're lower in price than what I own them at right now. So I'm constantly moving in and out of these funds and building the capital with the profits that I'm taking. So I have two streams of income, and the amounts that you can come up with are pretty phenomenal. I when I was managing money back in 2021, which you'll remember was quite an up year in the market, um, the investment, the distribution income for my client base of 110 million was about $7 million. So that's a comfortable 7% return, so to speak. But we made a whole nother 7% in profit taking. So actually 14 $14 million in that time frame, with the same couple hundred securities that I mentioned, um, trading them, buying them, taking profits on them, and then reinvesting again. So that's the type of approach that I use and that I explain in Retirement Money Secrets, that people can use with a very safe, very, I would say, very old type of a security. The closed-end funds have been around since the early 1800s. A lot of people think or say they were developed in Europe about 30 years before mutual funds came into existence in the United States, and over 100 years before ETFs were even thought about. ETFs are basically unmanaged portfolios, although some of the newer ones are coming out and saying that they're managed, and their only real objective is to grow in market value.
Right. Yeah, and this is the thing, like, as listening to I did a bunch of deep diving into, your interviews previous to this one that are all over on YouTube, and if people are listening to this and wanna know more, just Google Steve's name on YouTube, and you'll get a whole rack of this kind of conversation going on over there, and there's just a ton of detail. But the thing that struck me is that the way these closed-end funds are managed is that the person managing will go out and borrow money to buy more, like to increase the number of stock that they have within their portfolio. And so just the amount of profit that can come to you starts to increase because of that leveraging. And and that you're not, this is the thing that I was going, oh my God, this is so different. You're not an owner of the stock when you invest in these. You're, and you can explain the relationship better than
You're
I am, but
you're an owner of the trust. You
yes,
own
exactly.
you own the trust vehicle. The manager and the company, the trust itself, owns the securities. So unlike a mutual fund or an ETF, where if if the general population panics because of a correction or something, they always in Wall Street in Wall Street you always sell when prices go down, and you always and they get you excited when markets hit an all-time high, they think you should buy before it goes up even higher. So in reality, you'd be better off doing the opposite of that if you have a good quality base. But uh, for closed end funds, the important thing to recognize is that regardless of which way the market goes, the distribution income remains relatively the same. Over the past year, for example, there have been 70 or 80 individual increases in distributions among closed end funds, and only less than 10 have even reduced their distribution in the universes that I use for my investing and in my coaching services.
All right. So when we're talking about the income, that potential, what is the percent value of that income? Like when you're investing in something, what is the when a dividend comes to you, what's that percentage that you're getting? And this is where, people want to compare this against, well, I've got a mortgage over here. And wouldn't it be great if my return on these dividends that I was getting income wise were paying for my mortgage at the very least or more, doing, like covering my interest rate or whatever.
Sure.
So tell me, like, fill that in a little bit just so
Okay.
people get a good idea
Um,
of what
I'm
to
gonna
expect.
I'm gonna get you excited. I'm gonna tell you. I just did every month. Every month I analyze all the securities in what I call my universes. Like
Okay.
this would be my universe of income securities, and I have another one for equities and another one for tax free. And tax frees might get you really excited, but the 100 different equity closed end funds here, the average price of them on no on Oc- oh just this month was about 14.25 per share, and the average yield, this is on stock based securities, was over 9%. So if you're holding 10 or 15 of these securities as your portfolio, uh, and you diversify it properly, you could be owning 1,000. And the average number of shares inside are 246 different company shares inside. So you could literally be owning, you know, nearly 1,000 different companies throughout the world, and they're paying you 9%. And the typical payment is about 75% of them pay monthly, and the rest pay quarterly.
Wow.
And that income is coming in every month. On the income side, the prices are about 11.50 average, and the yield is a little over 10%. And in these guys they invest in bonds and preferred stocks and uh, mortgages and stuff like that. There's over 400 different securities in every fund. So the diversification is enormous, and the income is great. But here's something for let's say you're some of the some of the people who make enormous amounts of money um, in the audience, and they're tired of and they're paying this 30% tax rate or something like that. There's a list. I have a list of 50 tax-free municipals with the price is
Wow.
the price is less than $12 a share, and the average yield, federally tax free, is over 6% right now.
Wow.
Over 6%.
So you could take the money that you're paying in taxes, put it into that kind of investment and get a 6% income on it. Is
Exactly.
that right? Am I hearing you right?
You could take your money, invest some of it in tax free bonds,
Yeah.
and earn 6% federally tax free. And some of the ones are, for example, in that group, there are California, Massachusetts, New Jersey, New York, Missouri um, bonds that are state tax free as well.
Fascinating. This is
So,
so fascinating. Wow, this is amazing. So,
and
all right.
there's one other thing that's amazing, because a lot of your listeners may actually have experience in dealing with owning individual bonds, and you know the hassle it is to buy them and to sell them, how you have to get a bid and ask price, and that there's a markup, almost sometimes as much as a 2% markup when you go to buy them or sell them. And frankly, this is the reason why most advisors tell you to buy short-term bonds, because
Yeah.
they think you're, even a bond is going to pay the same amount of money no matter what its price is, and its price is going to vary with interest rate expectations. It's going to have no impact at all on the money you get. And when it matures, it's going to pay the face value. It doesn't matter what it was worth yesterday. When it matures, it's worth, for every $1,000 of face value, you're getting $1,000, period. So the idea of being short term so that the price doesn't fluctuate enough is merely a ploy to get you to turn these things over faster, because every time they turn over, the house gets 2%.
Yeah.
They get 2% when you sell it, if you sell it instead of just turning it in, and they get 2% when you buy a new one. Thus, please buy these short term bonds. They're good for my health, is what it is. So don't fall for that one. Don't fall for that one. The
Right.
same thing when they tell you to take your losses on bonds and buy some other one for tax purposes. Don't do it. Don't do it.
Right. Right. All right. Well, we're getting close to the end of our time today. This is so fascinating. Now I've only just scratched the surface of what I want to know, but I just want to mention that if people want to go deeper, you've got this book that is sitting there right behind you, Retirement Money Secrets. And people, if they want to go and learn all about this, that is one avenue. So talk about that, and just say, well, like, where can they find it?
Okay, well, it's everywhere. It's in, brick and mortar stores. You can order it there. I don't know how many of them have it sitting out there in their bins waiting to be picked up. I haven't seen it at Costco,
I
but
saw it on Amazon, and in fact, there's an audiobook version if people just want to listen, if they're not a
yeah,
reader,
now there's
just
an
listen to
audio
it.
book. But Amazon is the place where most people buy it. But it is available at the other stores, and like you said, there is an audio book, and it describes, in addition to what we're talking about, it talks about ways to minimize the risk in your portfolio, particularly with these types of closed-end funds. It talks about understanding the market cycle and getting used to the idea that prices are not going to just go up, they're going to go down, and tells you how to get into a position to take advantage of it in either direction, as you should be, and you should be able to do that pretty quickly. But I think the most important thing it does is it changes your mindset. It takes you from thinking only of the bottom line market value of your portfolio, and instead thinking out about the income that this enterprise, this department store of securities that you have, uh, you should be thinking about the income that it can generate for you. It goes into the idea of thinking about your investment portfolio like a store. Everything's for sale at a distinctly advertised, so to speak, markup. Somebody comes in and wants to buy something at a 5% profit for you. You take it and you replace it as quickly as you can with some other. You want to put something else on your shelf, or even the same product again, and sell it again, just like a department store would. But that's the mindset change you have to make, and you have to recognize that the stock market itself is a market just like any other market. It's going to go up and down in price. There are bids and asks, and you think of it like a capitalist running your store, and your store is your portfolio, and you will be able to successfully create an income stream that will take care of all your needs in retirement.
Wow. Yeah, that is a really different way to look at the stock market than just about anything I've ever heard. So like everybody's looking at it like they're going to Las Vegas and they're
I
rolling the
know.
dice.
And I've been doing it this way for 50 years. I mean, ever since
Yeah.
I started investing, when I started when I was 25 years old, I started doing my own investing, and I've always taken profits and looked for income from what I was doing. It's, you know, it's and people avoid taking profits for strange just because of taxes. Can you imagine if your employer came into your office and said, "Steve, I've you've been doing such a good job this year. I'm going to give you a $50,000 bonus." Would you say, "I don't want that $50,000. I'll have to pay taxes on it. I don't want that bonus." You would
Yeah.
never think of saying that. But you got $50,000 in profit in that Microsoft stock that's sitting in your portfolio, yielding less than 2%, and you won't take it and turn it into something that yields 10%. I think that's foolish. You should say, "Thank you, Microsoft, very much. You've been a great investment. I'm now going to say goodbye, and I'm going to place this in a bunch of other investments, and I'm going to make, 5 times as much money on it as I'm currently making with you."
Yeah, right, exactly. That's a really good, sort of thumbnail sketch view of how this works, and why not? Well, Steve, thank you so much for coming on today and explaining some of this. This is absolutely fascinating. It's kind of mind-blowing, and, I hope it's super helpful for the listeners, and if now you've described yourself as someone who's now teaching, are there ways for people other than your book to connect with the teaching that you're doing?
Oh yeah, sure. Although all the connection information is in the book,
Okay.
the my website is theincomecoach.net,
All right.
and it's out there for you, and all what I do to help people is described inside.
That's great. Well, I'll make sure that links to where the people can get your book and your website are in the show notes. And Steve, thanks again so much for coming on today.
My pleasure. My pleasure. Good speaking with you.
And for those of you listening at the end, I just want to remind you that if you'd like to go and get the entire archive of the Standout Business Show, just go to standoutbusiness.show. It's all there, all the audio, all the video, all the extra show notes and doodahs and freebies that the guests have put in there. You can subscribe so you never miss a future episode. You can binge to your heart's content. We go live every Tuesday and Thursday at 11 a.m. Eastern Time. And until the next time, so long.